Welcome to the latest video in our Finance 101 series for people new to the workplace or financial planning. This video is the first of a number focused on the subject of investment and looks at the difference between saving and investing. The two terms are often interchanged as if they mean the same thing. However, whilst they are both important parts of any financial plan, they are distinct and separate financial concepts that are designed to achieve different financial goals. So let's look at how they differ, starting with saving. Saving involves setting aside a portion of your income at regular intervals, perhaps every week or month. The primary purpose of saving is to build an emergency fund, cover short-term goals, or to have readily available cash for unexpected expenses. Savings are typically stored in low-risk, easily accessible accounts, such as bank savings accounts, which allow you to access your money quickly when needed. While savings accounts provide a safe place for your money, they usually offer a lower rate of return compared to other investment options, with the interest paid often being modest, and it may not keep pace with inflation, meaning the money you have saved may buy less in the future than you could buy today. Now let us look at investing and how it differs from saving. Investing involves putting money into assets with the aim of growing your money over the long term. Investors aim to generate returns, either in terms of income or capital gains, that outpace inflation and help achieve financial goals like retirement, buying a home, or funding education. You can invest in a range of asset classes at different risk levels, including equities or company shares, bonds, and property, details of which can be found in a separate video entitled Introduction to Asset Classes. However, all of them represent a higher level of risk than the deposit accounts typically used for shorter-term savings. The result of this higher risk is that your ability to access your money can be limited in two very different ways. Firstly, some investments lock you in for a predefined period. Secondly, as the value of investments goes up and down, the price that you will get for them will vary. During periods of market stress, the prices can be lower than you would want, so you may have to delay selling them to allow time for them to recover. Therefore, whilst the money is still accessible, that accessibility can come at a cost. So why do people invest? Quite simply because the potential returns are higher, and these higher returns can be key to accumulating the amount of money required to pay for major life costs, such as retirement. In summary, while saving provides a secure and accessible way to store money for short-term needs, investing aims to generate higher returns over the longer term, but involves a higher level of risk. A well-balanced financial strategy often involves a combination of the two based on an individual's goals, risk tolerance, and time horizon. I hope that you have found this video useful. If you want to enhance your investment knowledge further, you may wish to watch the other videos in the series. Alternatively, should you wish to discuss anything covered in this one, I can be reached at the email shown on the screen. Thanks for listening.